Have you ever noticed something strange on a stock chart? A stock falls, then suddenly stops falling. It bounces. Days later, it returns to the same area, and once again, buyers appear. Or perhaps a stock keeps rising, then reaches a certain price, and suddenly sellers appear again and again, almost as if an invisible wall exists. Coincidence? Not at all. Today, you're about to learn one of the most important concepts in trading and investing. A concept used by professional traders, hedge funds, institutions, and experienced investors around the world. Support and resistance. Master this lesson, and you will never look at a stock chart the same way again. Let's begin. Many beginners believe stock prices move randomly, up, down, without reason. But markets are driven by people, and people remember. Imagine you bought a stock at $100, the stock falls to $80, you regret not selling. Months later, the stock returns to $100. What are you likely to do? Many people sell, they want to break even. Now imagine another investor missed buying at 100. The stock rises to 130. Then it falls back to 100. That investor becomes excited. This is my chance. They buy. Notice what happened. Two groups of people made decisions around the same price. That is how support and resistance are created. Not by magic, by human behavior, by memory, by emotion, by psychology. Support is an area where buying pressure tends to be stronger than selling pressure. Think of support as a floor. When a ball falls toward the floor, it often bounces. Support works in a similar way. As price falls into a support zone, buyers begin to appear. The stock stops falling. Sometimes it even reverses higher. But here's something important. Support is not an exact price. Support is usually an area, a zone. A region where buyers have historically become active. This is one of the biggest mistakes beginners make. They draw a single line and expect perfection. Professionals think in zones, not exact numbers. Markets are not machines. They are collections of human decisions. Now let's discuss resistance. Resistance is the opposite of support. Resistance is an area where selling pressure tends to be stronger than buying pressure. Think of resistance as a ceiling. Imagine throwing a ball toward the ceiling. It hits the ceiling and falls back. When price reaches resistance, sellers often become active. Some investors take profits, others fear a decline. Some institutions reduce positions. As a result, the stock struggles to move higher. Again, resistance is usually a zone, not an exact price. The market often tests resistance multiple times before deciding what happens next. This is where the lesson becomes powerful. Support and resistance are not simply lines on a chart. They represent human psychology. Let's look at four emotions: fear, greed, hope, regret. Imagine a trader bought a stock at $50. The stock falls to $40. The trader regrets buying. Months later, the stock returns to $50. They finally sell. Thousands of traders think the same way. Now imagine another trader missed the move. They watch the stock rise from 50 to 80. Then it falls back to 50. They become excited. This is my opportunity. They buy. Both groups are acting because of emotion. And when enough people act together, support and resistance are born. The chart is simply recording human psychology. This is why support and resistance continue working decade after decade. Technology changes, markets evolve. Human nature remains surprisingly consistent. Large institutions cannot buy millions of shares instantly. If they try, they move the market. Instead, they often build positions near important support levels. Why? Because risk can be controlled. If support fails, they know they are wrong. Likewise, institutions often reduce positions near resistance. Why? Because probability becomes less favorable. This is one reason professional traders pay so much attention to these areas. Support and resistance help identify locations where major decisions are likely to occur. Notice something important. Professionals focus on locations. Beginners focus on predictions. Professionals ask, where's the best place to act? Beginners ask, what will happen tomorrow? One mindset creates discipline, the other creates gambling. Now let's learn one of the most important concepts in technical analysis, role reversal. Imagine support breaks. Price falls through the floor. What happens next? Many investors who bought near support are now losing money. When price returns to that area, they often sell. As a result, old support becomes new resistance. The opposite can also happen. When resistance breaks, it often becomes future support. This concept appears constantly in financial markets. And once you learn to recognize it, you'll begin seeing it everywhere. Some traders build entire strategies around this idea alone. Let's avoid some dangerous mistakes. Mistake number one, drawing too many lines. If your chart looks like a spider web, you're probably overcomplicating things. Mistake number 2, treating support and resistance as exact prices. Remember, think zones, not numbers. Mistake number 3, ignoring volume. Strong support with high volume is often more meaningful than support with weak volume. Mistake number 4, buying blindly. Support is not a guarantee. Nothing in markets is guaranteed. Always seek confirmation. Always manage risk. Professional traders rarely buy randomly. They wait, they observe. They allow price to approach important areas. Then they study the reaction. Are buyers becoming aggressive? Is volume increasing? Are sellers losing control? Instead of chasing price, they let the market come to them. Patience is a competitive advantage. The market rewards discipline far more often than excitement, and support and resistance help create that discipline. The real purpose of support and resistance is not prediction. The purpose is preparation. You are identifying areas where important decisions may occur. You are creating a framework, a map, a structure for thinking logically instead of emotionally. That is what separates professionals from amateurs. Today's challenge is simple. Open 5 stock charts. Find 3 support zones, 3 resistance zones. Then observe how price reacted around those areas. Ask yourself, who is in control, the buyers or the sellers? Do this every day. Within a few weeks, your chart reading ability will improve dramatically. Today you learned one of the foundations of technical analysis, support and resistance. You learned that these levels are not magic. They are reflections of human psychology, institutional activity, and collective decision-making. Tomorrow we will take another important step. We will learn trend analysis. How to identify whether a market is moving higher, moving lower, or moving sideways. Because before you buy or sell anything, you must answer one question. What direction is the market actually moving? Thank you for watching. Subscribe to Wealth Entertainment 21, turn on notifications so you never miss a lesson. And remember, the market leaves clues. Support and resistance are among the most important clues you will ever learn to recognize. I'll see you in episode 6.